The stock market, though a term frequently encountered in news headlines and casual conversation, often remains frustratingly abstract to those outside the financial world. At its core, it is a system through which ownership stakes in companies are bought and sold among investors. In essence, it is the mechanism by which capital flows from those who have it to those who need it, creating a marketplace for partial ownership in businesses. The principal function of stock markets is to facilitate the efficient allocation of resources while providing investors opportunities for wealth accumulation. Achieving this understanding requires drawing from multiple disciplines. Economics, accounting, and mathematics all contribute to market analysis, as do broader studies in psychology, statistics, and even history. There is also a role for technology, particularly as electronic trading and algorithmic systems have transformed market operations. Mathematics, after all, tends to show up at any party involving serious thought. Investors approach markets through four main lenses: the individual investor level, where the focus is on personal portfolio construction and specific security selection. Moving up, the institutional level investigates how large organizations, pension funds, endowments, and mutual funds allocate billions across markets. The corporate level examines how companies use markets to raise capital, repurchase shares, and signal confidence. Finally, market-level analysis takes the broadest view, considering both participant behavior and regulatory frameworks as an integrated whole. Beyond the academic intrigue, stock market literacy has practical value. Understanding market mechanisms helps individuals address financial needs, securing retirement income, building wealth, and achieving long-term objectives. Market participants operate in a range of settings, from home computers executing online trades to institutional trading desks managing multi-billion-dollar portfolios. Applied market knowledge also plays a role in broader economic participation. Individuals may study markets to manage personal investments, while corporations monitor them to optimize the timing of capital raises or share buybacks. Market professionals take on a variety of roles, including that of financial advisor, guiding clients across wealth management firms and independent practices. Others serve as analysts, researching companies and industries to identify investment opportunities. Some do both. Participating in markets typically starts with opening a brokerage account, and perhaps some self-education, though more sophisticated approaches often involve professional guidance or formal study. A solid grasp of basic finance, mathematics, and risk management is essential, which is unfortunate for anyone hoping to avoid numbers altogether. On a global scale, many forces, both economic and psychological, shape market behavior. Capital markets, while vast in total value, represent only one component of the broader financial system. They stretch across time zones, connecting investors in New York with opportunities in Tokyo, London, and Shanghai. Their participants, millions of individuals and institutions, are influenced by earnings reports, economic data, and countless other factors which together determine where prices move and when. And so, while stock market study may start with questions about individual companies and specific trades, it ends with insights about human behavior, resource allocation, and economic systems. THEMS equity ownership, the cornerstone of stock market activity, represents something more concrete than many realize. When an individual purchases a share of stock, they acquire fractional ownership in an actual enterprise, with real assets, real employees, and real operations. This ownership, however small the percentage, carries specific rights and responsibilities that extend beyond simply hoping for price appreciation. Stocks divide into two primary categories, common and preferred, each carrying distinct characteristics. Common stock, the most prevalent form of equity ownership, grants shareholders voting rights in corporate decisions, typically one vote per share. These shareholders elect board members, approve major corporate actions, and participate in governance through proxy voting. Common stockholders also hold residual claims on company assets, meaning they receive distributions only after all debts and preferred obligations are satisfied. In contrast, preferred stock sacrifices voting rights in exchange for priority in dividend payments and asset claims. Preferred shareholders receive dividends before common shareholders, and these dividends are often fixed rather than variable. During liquidation, preferred stockholders stand ahead of common shareholders, but behind all creditors in the distribution hierarchy. The mechanics of stock ownership involve several technical concepts that shape market behavior. Par value, a largely archaic figure printed on stock certificates, represents the nominal value assigned at issuance, often 1 penny or $1 per share. Market value, the price at which shares actually trade, bears little relationship to par value, and instead reflects investor perceptions of company worth and future prospects. Outstanding shares represent the total number of shares a company has issued and not repurchased, encompassing both actively traded shares and those held by insiders or institutions. The float, a subset of outstanding shares, includes only those available for public trading, excluding shares held by company executives, employees with lock-up restrictions, and strategic investors. Treasury stock refers to shares the company has repurchased from the market, which no longer carry voting rights or receive dividends until reissued. The distinction between public and private companies hinges on whether shares trade on established exchanges. Private companies owned by founders, employees, or private investors face minimal disclosure requirements and restrict share transferability. Public companies, having completed an initial public offering or IPO, list their shares on exchanges where anyone can purchase ownership stakes. This transition from private to public involves substantial costs, SEC registration requirements, ongoing disclosure obligations, and exposure to market volatility. Companies undertake this process to raise capital for expansion, provide liquidity to early investors, use shares for acquisitions, or enhance their public profile. Shareholder rights extend beyond voting and dividends. Stockholders receive regular financial disclosures, attend annual meetings, either in person or by proxy, and can propose certain shareholder resolutions. Some companies issue different share classes to maintain founder control while accessing public capital. Class A shares might carry 1 vote per share, while Class B shares carry 10 votes per share, allowing founders to retain decision-making authority despite owning a minority of total equity. Berkshire Hathaway, for instance, offers both Class A shares, trading above $500,000 each, and Class B shares representing fractional ownership at more accessible prices. The distribution of ownership through stock issuance transforms private enterprises into public ones, fundamentally altering their relationship with capital, transparency, and accountability. What begins as a concentrated ownership structure evolves into a dispersed shareholder base, introducing both opportunities for capital formation and complexities in governance and control. ELVs, stock exchanges, serve as the organized venues where securities change hands, though the nature of these venues has evolved considerably. While images of traders gesturing frantically on crowded floors persist in popular culture, most modern trading occurs through electronic networks where algorithms match buyers and sellers in milliseconds. The function remains constant, even as the form has transformed. The New York Stock Exchange, located at 11 Wall Street in New York City, maintains a physical trading floor where designated market makers, specialists assigned to specific stocks, facilitate transactions and maintain orderly markets. These specialists hold obligations to provide liquidity by standing ready to buy when sellers appear and sell when buyers arrive, profiting from the spread between these prices. The floor, though diminished in importance, continues operating for symbolic reasons and for certain complex transactions requiring human judgment. In contrast, the Nasdaq operates as a fully electronic exchange, having abandoned physical trading since its inception in 1971. Orders route through computer systems that match buy and sell requests based on price and time priority, executing thousands of transactions per second without human intermediaries. Companies seeking to list shares on exchanges must meet specific requirements that vary by venue. The NYSE typically requires minimum market capitalization, around $200 million, at least 1.1 million publicly traded shares, a minimum share price of $4, and demonstrated profitability or revenue thresholds. Nasdaq maintains somewhat different standards, emphasizing factors like corporate governance, minimum bid price, and shareholder equity levels. These listing standards serve multiple purposes. They ensure that only companies of sufficient size and stability trade publicly. They protect investors from extremely speculative or fraudulent enterprises, and they maintain the exchange's reputation for quality. Trading occurs during regular hours, 9:30 a.m. to 4 p.m. Eastern Time, on weekdays, though extended sessions allow limited activity before and after these core hours. Market makers and specialists maintain quotes, posting bid prices at which they will purchase shares and ask prices at which they will sell. The difference between these prices, the bid-ask spread, represents compensation for providing continuous liquidity and bearing inventory risk. Spreads vary with liquidity. Highly traded stocks like Apple might show spreads of 1 cent per share, while thinly traded small companies might display spreads of several dollars. Imagine placing an order to purchase 100 shares of a moderately liquid stock currently trading at $50. Your broker sends this order electronically to the exchange, where it enters a queue organized by price and time. If you placed a market order, it executes immediately at the best available ask price, perhaps $50.50. If you placed a limit order specifying a maximum price of $50, it waits in the queue until a seller accepts that price, or until you cancel the order. Throughout this process, the exchange's matching engine continuously processes incoming orders, pairing buyers and sellers according to established priority rules. The infrastructure of exchanges, whether physical or electronic, ultimately facilitates the core function of bringing together buyers and sellers for efficient price discovery and transaction execution. Regional exchanges and alternative trading systems supplement the major venues, creating a competitive landscape where orders can route to whichever venue offers optimal execution. Markets comprise diverse participants, each operating with distinct objectives, time horizons, and strategies. Understanding who trades and why provides essential context for market movements and price formation. These participants range from individuals managing personal retirement accounts to sophisticated institutions deploying billions in capital across global markets. Retail investors, individual participants trading personal accounts, represent the most visible market segment despite generating a minority of total volume. These investors typically purchase shares in quantities ranging from dozens to thousands, hold positions for months or years, and make decisions based on varying levels of research and analysis. Their participation surged with the advent of commission-free trading platforms and increased accessibility through mobile applications. While retail investors collectively influence markets, particularly during periods of coordinated activity, individual retail trades rarely move prices noticeably. Institutional investors operate at vastly different scale. Mutual funds, pension funds, insurance companies, and endowments manage trillions in aggregate assets, executing block trades involving hundreds of thousands or millions of shares. These entities employ professional portfolio managers, conduct extensive research, and maintain long-term investment horizons measured in years or decades. Institutional ownership typically accounts for 70 to 80% of trading volume in major stocks, and their buying or selling can significantly impact prices. When a pension fund decides to build a position in a company, the order might be split across days or weeks to avoid excessive price movement. Day traders and high-frequency traders occupy the opposite end of the time spectrum. Day traders, whether individuals or small firms, open and close positions within single trading sessions, seeking to profit from intraday price movements. High-frequency trading firms use sophisticated algorithms and direct market connections to execute thousands of trades per second, capturing fractional profits from tiny price discrepancies. These ultra-short-term participants provide liquidity and tighten spreads, but also introduce complexity and potential instability during market stress. Market makers fulfill a specialized role, maintaining continuous bid and ask quotes to facilitate trading. Compensated through spreads rather than directional bets, these firms profit from transaction volume, regardless of price direction. Corporate participants also engage markets, repurchasing shares when management believes stock prices undervalue the business or when excess capital lacks productive alternative uses. The interplay among these diverse participants, each pursuing distinct strategies across different time horizons, generates the continuous price discovery and liquidity that characterize functioning markets. The mechanics of trade execution, while largely invisible to casual observers, involve specific order types and pricing structures. When an investor decides to buy or sell a security, they must communicate not only what to trade, but also under what conditions that trade should occur. This choice between order types significantly influences execution price, timing, and certainty. Market orders execute immediately at the best available price. An investor submitting a market buy order receives shares at the current ask price, the lowest price any seller currently offers. A market sell order executes at the bid price, the highest price any buyer currently offers. Market orders guarantee execution, but not price, in highly liquid stocks with tight spreads. This uncertainty matters little. In thinly traded securities or during volatile periods, the execution price might differ substantially from the last traded price observed before order submission. Limit orders specify maximum purchase prices or minimum sale prices. A buy limit order at $50 executes only if shares become available at $50 or below. A sell limit order at $55 executes only if buyers appear willing to pay $55 or more. These orders provide price certainty, but not execution certainty. They enter a queue organized by price first, then time of submission. Better priced orders execute before worse priced orders. Among orders at the same price, earlier submissions receive priority. Limit orders might never execute if market prices fail to reach specified levels. Stop orders activate once prices reach designated trigger points. A stop-loss sell order at $45 on a stock currently trading at $50 converts to a market order if the price falls to $45, limiting potential losses. Stop limit orders combine both features, converting to limit orders rather than market orders upon triggering. This prevents execution at unacceptable prices but reintroduces execution uncertainty. The bid-ask spread, the difference between the highest bid and lowest ask, reflects several factors. Highly liquid stocks with millions of shares trading daily display spreads measured in pennies. Apple or Microsoft might show spreads of 0.01 on a $150 stock, roughly 0.07%. Small cap stocks with minimal trading activity might display spreads of $0.50 or more on $10 stocks, representing 5% or higher. Market makers earn these spreads as compensation for maintaining continuous quotes and holding inventory that might decline in value. Order execution follows strict priority rules. Price takes precedence. Better priced orders execute before worse priced orders, regardless of submission time. Among identically priced orders, time determines priority. An order submitted at 10 or a.m. executes before an identical order submitted at 10:01 a.m. Partial fills occur when available shares, at desired prices, fall short of order size. An order for 1,000 shares might execute 600 shares immediately, with the remaining 400 shares staying active until more sellers appear or the order expires. Through these order types and execution mechanisms, markets translate investor intentions into actual transactions, maintaining continuous flow while accommodating diverse timing preferences and price sensitivities. Market indices serve as statistical measures of market performance, aggregating the price movements of selected securities into single reference points. These indices function both as performance benchmarks and as indicators of broader economic sentiment. While no index can capture the entire market perfectly, several have become standard measures by which investors assess market direction and portfolio performance. The Dow Jones Industrial Average, established in 1896, tracks 30 large-cap American companies selected by the editors of the Wall Street Journal. This index uses price weighting, meaning higher-priced stocks exert greater influence regardless of company size. A stock trading at $300 affects the index 10 times more than a stock trading at $30, even if the cheaper stock represents a larger company by market capitalization. This methodology, while intuitive in earlier eras, creates distortions that make the Dow less representative than alternatives. The S&P 500 employs market capitalization weighting across 500 large US companies. Here, each company's influence corresponds to its total market value, calculated by multiplying share price by outstanding shares. Apple, with a market capitalization exceeding $2 trillion, moves the index far more than a $10 billion company. This approach better reflects actual market value distribution and has made the S&P 500 the preferred benchmark for institutional investors and index fund managers. The Nasdaq Composite includes over 3,000 stocks listed on the Nasdaq exchange, heavily weighted toward technology companies, due to that exchange's historical focus on growth and innovation sectors. The Russell 2000 concentrates on small-cap stocks, providing a benchmark for companies too small for inclusion in the S&P 500. Together, these indices offer perspectives on different market segments, company sizes, and sector concentrations. Index funds and exchange-traded funds now replicate these benchmarks, allowing investors to purchase proportional stakes in entire indices rather than selecting individual securities. This passive approach has gained substantial market share, as evidence accumulates that most active managers fail to consistently outperform broad indices after accounting for fees. These indices, while imperfect proxies for market health, provide standardized reference points against which individual performance can be measured and compared. Sector-specific indices further subdivide markets, tracking technology, healthcare, energy, and other industries independently. Financial markets operate within a framework of regulations designed to ensure fairness, transparency, and investor protection. These rules, enforced by governmental and self-regulatory bodies, shape permissible behavior and establish consequences for violations. The regulatory architecture emerged primarily in response to the 1929 stock market crash and subsequent Great Depression, when unregulated markets and fraudulent practices devastated millions of investors. The Securities and Exchange Commission, created by the Securities Exchange Act of 1934, holds primary authority over U.S. securities markets. This federal agency oversees exchanges, broker-dealers, investment advisors, and public companies, ensuring compliance with securities laws and prosecuting violations. The SEC requires public companies to file detailed financial disclosures, register securities offerings, and maintain accurate records. Annual reports on Form 10K provide comprehensive financial statements and business descriptions. Quarterly reports on Form 10Q update investors between annual filings. Form 8K disclosures must be filed within 4 business days of material events such as acquisitions, executive departures, or bankruptcy filings. FINRA, the Financial Industry Regulatory Authority, operates as a self-regulatory organization overseeing broker-dealers and their registered representatives. This private entity writes rules governing broker conduct, examines firms for compliance, and disciplines violators through fines, suspensions, or permanent bars from the industry. FINRA also operates the arbitration system through which investors resolve disputes with brokers. Insider trading prohibitions prevent corporate insiders from trading based on material, non-public information. Officers, directors, and large shareholders must report their trades publicly and face restrictions on short-term trading. Violations carry substantial penalties, including fines, disgorgement of profits, and imprisonment. Notable prosecutions have involved hedge fund managers, corporate executives, and even members of Congress, though enforcement remains imperfect and controversial. Circuit breakers automatically halt trading when markets decline precipitously. Level 1 halts trigger at a 7% decline from the previous close, Level 2 at 13%, and Level 3 at 20%. These mechanisms aim to prevent panic selling and allow participants time to assess conditions. Individual securities also face trading halts when material news breaks or when unusual volatility occurs. This regulatory architecture, while imperfect, establishes the rules of market engagement and provides mechanisms for addressing violations when they occur. Debates continue regarding optimal regulation intensity, balancing investor protection against market efficiency and innovation. Bonds represent a fundamentally different relationship between investor and issuer than stocks do. Where equity ownership grants partial ownership in an enterprise, bond ownership creates a creditor-debtor relationship with specified terms and payment schedules. The bondholder lends money to the issuer and receives contractual promises of repayment plus interest, regardless of the issuer's profitability or success. A typical bond involves several standard components. The principal or face value, usually $1,000 for corporate bonds, represents the amount returned at maturity. The coupon rate, expressed as an annual percentage of face value, determines periodic interest payments, typically distributed semi-annually. Maturity indicates when the principal must be repaid, ranging from months to 30 years or longer. A bond with a 5% coupon and $1,000 face value pays $50 annually, usually as two $25 payments, until maturity when the issuer returns the $1,000 principal. Bonds divide into categories based on issuer type. U.S. Treasury bonds, backed by the federal government's taxing authority, are considered the risk-free benchmark against which all other bonds are measured. Corporate bonds, issued by companies to finance operations or expansions, carry credit risk corresponding to the issuer's financial stability. Municipal bonds, issued by state and local governments, often provide tax advantages, as their interest typically escapes federal income taxation and sometimes state taxation for residents. Credit rating agencies, primarily Moody's, Standard & Poor's, and Fitch, assess bond credit risk and assign letter grades. AA, or AA, represents the highest quality with minimal default risk. Ratings descend through AA, A, BBB, and into speculative or junk territory at BB and below. Lower-rated bonds must offer higher yields to compensate investors for elevated default risk. A company rated BBB might pay 5%, while a B-rated company with shakier finances must pay 8% or more for equivalent maturity. Bond prices move inversely to interest rates, a relationship crucial to understanding bond behavior. When prevailing interest rates rise, existing bonds paying lower coupons become less attractive, causing their market prices to fall below face value. When rates decline, existing bonds paying higher coupons become more valuable, trading above face value. A bond issued at 4% when prevailing rates were 4% will trade below $1,000 if rates subsequently rise to 5%, and above $1,000 if rates fall to 3%. While less glamorous than stocks, bonds provide the ballast that stabilizes portfolios and generates predictable income streams, particularly valuable as investors age or market volatility increases. The certainty of contractual payments contrasts sharply with the variable and uncertain nature of stock dividends and capital gains. Exchange-traded funds, a relatively modern innovation in investment vehicles, combine characteristics of both mutual funds and individual stocks. These securities trade on exchanges like stocks while holding diversified portfolios like mutual funds. The first ETF, the SPDR S&P 500 Trust, launched in 1993, has since been joined by thousands of alternatives covering virtually every conceivable market segment, strategy, and asset class. ETFs function through a creation and redemption mechanism involving authorized participants, typically large financial institutions. These participants can exchange baskets of underlying securities for ETF shares or redeem ETF shares for underlying securities. This process keeps ETF market prices closely aligned with the net asset value of holdings, preventing significant premiums or discounts from developing. The mechanism also provides tax efficiency advantages, as portfolio changes can occur without triggering taxable events for remaining shareholders. Most ETFs track indices, replicating the holdings and weightings of benchmarks, like the S&P 500, Russell 2000, or sector-specific indices. Index ETFs charge minimal expense ratios, often between 0.03 and 0.20% annually, far below typical mutual fund fees. This cost advantage, combined with the transparency of knowing exactly what securities the ETF holds, has driven explosive growth. Global ETF assets now exceed $10 trillion. Beyond broad market index ETFs, specialized varieties have proliferated. Sector ETFs concentrate on specific industries like technology, healthcare, or energy. International ETFs provide exposure to foreign markets without the complexity of buying foreign securities directly. Commodity ETFs track gold, oil, or agricultural products. Bond ETFs hold fixed income portfolios. Actively managed ETFs, where portfolio managers make discretionary security selections rather than tracking indices, represent a growing but still minority segment. While mutual funds price once daily at market close, ETFs trade continuously throughout market hours, allowing investors to buy or sell at any moment. This intraday liquidity appeals to tactical traders, but matters little to long-term investors. ETFs also permit short selling and options trading, strategies unavailable with mutual funds. The proliferation of ETFs has democratized access to diverse investment strategies, allowing retail investors to execute sophisticated allocation approaches once available only to institutions. Whether this expansion represents genuine innovation or excessive financial engineering remains debated, but the transformation of portfolio construction methods appears irreversible. Mutual funds, among the oldest pooled investment vehicles, aggregate capital from multiple investors to purchase diversified portfolios managed by professional fund managers. These funds provide access to professional management and diversification even for investors with modest capital. The first modern mutual fund, Massachusetts Investors Trust, began operations in 1924, nearly 7 decades before ETFs emerged. Open-end mutual funds, the dominant structure, issue and redeem shares directly with investors at net asset value, calculated daily after market close. NAV equals total portfolio value minus liabilities, divided by shares outstanding. A fund holding securities worth $100 million with 10 million shares outstanding has a $10 NAV. Investors purchasing shares pay this NAV, perhaps plus a sales charge or load, and receive the same NAV when redeeming. Closed-end funds issue fixed share counts that trade on exchanges, often at premiums or discounts to NAV. Load structures vary. Front-end loads charge commissions when purchasing shares, typically ranging up to 5.75%. Back-end loads assess fees when redeeming shares, usually declining over time to encourage longer holding periods. No-load funds charge neither, though all funds assess ongoing management fees through expense ratios. These annual charges, expressed as percentages of assets, range from 0.10% for simple index funds to 2.0% or more for actively managed specialty funds. Share classes complicate matters further. Class A shares typically carry front-end loads, but lower ongoing expenses. Class B shares charge back-end loads and higher annual expenses. Class C shares avoid front-end loads, but maintain elevated ongoing costs. These structures primarily serve broker compensation rather than investor benefit. In contrast to ETFs, which trade continuously, mutual funds execute all orders at the 4:00 p.m. closing NAV, regardless of when during the day investors submit orders. This eliminates intraday trading, but also removes timing advantages or disadvantages. Despite competition from ETFs, mutual funds remain significant investment vehicles, particularly within employer-sponsored retirement plans, where their structures facilitate automatic payroll deductions and regular contributions. Assets in mutual funds still exceed $20 trillion in the United States alone. The universe of tradable securities extends beyond common stocks and bonds to include specialized instruments designed for specific investor needs or market conditions. These alternatives offer varied risk-return profiles and serve distinct portfolio functions, though they represent smaller market segments than primary securities. Real estate investment trusts, or REITs, provide equity exposure to property assets without the complications of direct ownership. These companies own and operate income-producing real estate, such as office buildings, apartments, shopping centers, or warehouses. Federal tax law requires REITs to distribute at least 90% of taxable income as dividends, making them attractive for income-seeking investors. REITs trade like stocks, offering liquidity that physical real estate cannot match. Preferred stocks occupy a middle ground between common stocks and bonds. These hybrid securities pay fixed dividends like bonds, but represent equity ownership like stocks. Preferred shareholders receive dividends before common shareholders and hold priority claims during liquidation, but they sacrifice voting rights and participation in growth beyond the fixed dividend rate. Convertible bonds begin as debt, but grant holders options to convert into common stock at predetermined ratios. These securities offer bond-like downside protection with equity-like upside participation if the company thrives and its stock price rises above conversion levels. American Depository Receipts, or ADRs, represent foreign company shares but trade on US exchanges in dollars. These instruments provide access to international companies without navigating foreign exchanges, currency conversion, or unfamiliar settlement procedures. Derivatives, including options and futures contracts, derive value from underlying securities rather than representing direct ownership. These complex instruments serve hedging and speculative purposes, but involve substantial risks and require specialized knowledge. Together, these specialized securities expand the toolkit available to investors, allowing portfolio construction tailored to specific objectives, risk tolerances, and time horizons. Fundamental analysis represents one approach to security valuation, focusing on the intrinsic worth of companies through examination of financial statements, competitive positions, and economic environments. Practitioners of this method attempt to determine whether current market prices accurately reflect underlying business value, seeking opportunities where discrepancies exist. The approach divides into two primary frameworks. Top-down analysis begins with macroeconomic conditions, progresses to sector selection, and concludes with individual security choices within favored industries. An investor following this path might determine that economic expansion favors cyclical sectors, identify industrials as particularly promising, and then select specific manufacturing companies. Bottom-up analysis inverts this sequence, focusing first on individual company quality, regardless of broader economic or sector conditions. These investors seek exceptional businesses at reasonable prices, believing that superior companies prosper across various economic environments. Both qualitative and quantitative factors inform fundamental analysis. Quantitative assessment examines measurable data, revenue growth rates, profit margins, return on equity, debt levels, and cash generation. These numbers, extracted from financial statements, allow objective comparisons across companies and time periods. Qualitative evaluation considers less tangible elements: management quality, competitive advantages, brand strength, regulatory risks, and industry dynamics. A company might display impressive financial metrics, yet face qualitative challenges like pending patent expirations, management turnover, or disruptive competitive threats. Fundamental investors typically operate with longer time horizons than technical traders, measuring holding periods in months or years rather than days or weeks. This extended time frame reflects the belief that market prices eventually converge toward intrinsic value, though timing remains uncertain. Warren Buffett and Benjamin Graham exemplify this approach, building fortunes through patient analysis of business fundamentals rather than price chart patterns. Technical analysis, examined subsequently, takes a fundamentally different approach, studying price movements and trading patterns rather than business operations and financial results. Where fundamental analysts ask what a company is worth, technical analysts ask where the stock price is heading. While no valuation method proves infallible, fundamental analysis provides a systematic framework for assessing business quality and identifying potential discrepancies between price and value. Its effectiveness depends on analytical skill, information quality, and the patience to wait for market recognition of undervaluation or overvaluation. Financial statements serve as the formal record of a company's economic activities, translating business operations into standardized numerical formats. These documents, required of all publicly traded companies, provide the raw material for fundamental analysis and valuation. Three primary statements capture different dimensions of financial performance and position. The income statement summarizes revenues, expenses, and profitability over a specific period, typically a quarter or year. It begins with total revenues or sales, subtracts the cost of goods sold to arrive at gross profit, then deducts operating expenses such as salaries, marketing, and research to reach operating income. After accounting for interest expense and taxes, the statement concludes with net income, the bottom line figure representing profit available to shareholders. This statement reveals whether the company generates profits, how margins compare to competitors, and whether profitability trends upward or downward. The balance sheet presents a snapshot of assets, liabilities, and shareholders' equity at a specific moment. Assets, items the company owns or controls, divide into current assets like cash and inventory, expected to convert to cash within 1 year, and long-term assets like property and equipment. Liabilities represent obligations, similarly split between current liabilities, due within 1 year, and long-term debt. Shareholders' equity, the residual after subtracting liabilities from assets, represents the accounting value of ownership stakes. The fundamental equation, assets equal liabilities plus shareholders' equity, must always balance. This statement reveals what the company owns, what it owes, and the book value of equity. The cash flow statement tracks actual cash movements through three categories. Operating activities show cash generated from core business operations, a crucial measure distinct from accounting profits. Investing activities capture cash spent on capital expenditures, acquisitions, or securities, as well as cash received from asset sales. Financing activities record cash from issuing debt or equity and cash paid for dividends or debt repayment. This statement matters because companies can report accounting profits while hemorrhaging cash, a situation that eventually leads to distress. These three statements interconnect in important ways. Net income, from the income statement, flows into shareholders' equity on the balance sheet, increasing the ownership value. It also appears as the starting point for the operating cash flow section, though numerous adjustments reconcile accounting income to actual cash. Capital expenditures, from the cash flow statement, increase long-term assets on the balance sheet. Debt issued or repaid in the financing section alters liability balances. Public companies file these statements quarterly on Form 10Q, within 40 to 45 days of quarter end, and annually on Form 10K, within 60 to 90 days of year end. All filings appear on the SEC's EDGAR database, freely accessible to investors. Generally Accepted Accounting Principles, or GAAP, standardize presentation to facilitate comparisons, though companies retain some discretion in classifications and estimates. Together, these three statements provide complementary perspectives on financial health, revealing profitability, solvency, and cash generation capacity in ways that individual statements cannot. Financial ratios distill complex financial statements into comparable metrics that facilitate company evaluation and peer comparison. These standardized measures allow investors to assess valuation, profitability, efficiency, and financial health using consistent frameworks. Rather than comparing absolute dollar amounts across companies of vastly different sizes, ratios normalize data into percentages and multiples that enable meaningful analysis. Valuation ratios help determine whether stock prices appear reasonable relative to underlying business metrics. The price-to-earnings ratio, calculated by dividing stock price by earnings per share, indicates how much investors pay for each dollar of annual profit. A stock trading at $100 with earnings of $5 per share has a P/E ratio of 20. Technology companies often trade at P/E ratios of 25, 30, or higher, reflecting expectations for rapid future growth. Utilities and mature industrial companies typically trade at P/E ratios of 10 to 15, reflecting slower growth and lower investor enthusiasm. The S&P 500 historically averages P/E ratios between 15 and 20, though this fluctuates with economic conditions and interest rates. The price-to-book ratio compares market price to book value per share, the accounting value of equity divided by shares outstanding. P/B ratios below 1.0 suggest the market values the company below its accounting net worth, potentially indicating undervaluation or fundamental problems. Technology and service companies often trade at high P/B ratios since their value resides in intellectual property rather than physical assets, while banks and manufacturers trade closer to book value. The PEG ratio, price to earnings divided by expected annual earnings growth rate, attempts to account for growth differences. A stock with a PE of 20 and expected 20% annual growth has a PAG of 1.0. PEG ratios below 1.0 suggest the stock is cheap relative to growth prospects, while ratios above 2.0 might indicate overvaluation or excessive optimism. Profitability ratios measure how effectively companies convert revenues into profits. Return on equity, calculated as net income divided by shareholders' equity, reveals how much profit the company generates from shareholder investment. ROE of 15% or higher generally indicates strong performance, though this varies by industry. Return on assets, net income divided by total assets, shows how efficiently the company deploys all resources regardless of financing structure. Profit margins, net income divided by revenue, indicates how much of each sales dollar reaches the bottom line after covering all expenses. Liquidity ratios assess short-term financial stability. The current ratio, current assets divided by current liabilities, measures ability to meet near-term obligations. Ratios above 1.5 suggest adequate liquidity, though excessively high ratios might indicate inefficient capital deployment. The quick ratio subtracts inventory from current assets before dividing by current liabilities, providing a more conservative measure. Leverage ratios evaluate debt levels. The debt-to-equity ratio compares total debt to shareholders' equity, revealing how much the company relies on borrowed funds. Higher ratios increase financial risk, but also magnify returns when business prospers. Interest coverage ratio, operating income divided by interest expense, indicates how easily the company meets debt obligations. Ratios gain meaning through context. Comparing a company's current ratios to its historical ratios reveals trends. Comparing to industry peers identifies relative strengths and weaknesses. However, ratios cannot capture qualitative factors like competitive threats, management quality, or technological disruption. Accounting differences and one-time items can distort ratios significantly. While no single ratio provides complete insight, patterns across multiple metrics reveal financial characteristics that help investors distinguish robust businesses from financially strained ones. Beyond financial metrics, company quality depends on qualitative factors that numbers alone cannot capture. Competitive advantages, management competence, business model durability, and industry dynamics all influence long-term success in ways that extend beyond current financial statements. These softer elements often prove decisive in determining which companies sustain superior returns over decades rather than quarters. Competitive advantages, sometimes called economic moats, protect businesses from competitors seeking to capture their profits. Brand strength provides one such advantage. Coca-Cola's brand recognition allows premium pricing and shelf space dominance that generic cola producers cannot match. Network effects create another moat, where product value increases as more users join. Facebook's social network becomes more valuable as more people use it, making new entrants nearly impossible to establish. Cost advantages from scale, proprietary technology, or favorable locations enable companies like Walmart to underprice competitors sustainably. Regulatory barriers, such as patents for pharmaceutical companies or licenses for utilities, legally prevent competition for defined periods. Business model evaluation examines how companies generate revenue and whether that model scales efficiently. Software companies typically enjoy high gross margins, often 70 to 90%, since distributing additional copies costs almost nothing. Retailers operate on thin margins, often 2 to 5%, due to inventory costs and competition. Capital intensity matters significantly. Manufacturing businesses require constant equipment investment to maintain operations, while consulting firms primarily need talented employees. Business models that scale without proportional cost increases generally command higher valuations. Management assessment presents greater challenges since it involves subjective judgment about people rather than objective measurement of numbers. Track records provide some guidance. Has management allocated capital wisely through the cycle? Do acquisitions create value or destroy it? Insider ownership aligns management interests with shareholders when executives hold substantial personal stakes. Compensation structures reveal priorities. Does the board reward long-term value creation or short-term metric manipulation? Share buyback history shows capital allocation philosophy. Companies repurchasing shares at high prices destroy value, while those buying at low prices enhance it. Industry analysis examines the competitive landscape surrounding individual companies. Highly concentrated industries, dominated by a few large players, oligopolies, often allow rational pricing and reasonable profitability. Airlines demonstrate the opposite problem. Fragmented industries with low barriers to entry, where excess capacity drives prices below sustainable levels. Disruption risks vary by sector. Technology companies face constant threats from innovation, while utilities enjoy stable, regulated businesses resistant to sudden change. Porter's Five Forces framework systematically evaluates competitive intensity, supplier power, buyer power, threat of substitutors, and barriers to entry. Consider two companies with identical financial ratios but different qualitative profiles. One possesses strong brands, competent management, and dominant market position in a growing industry. The other operates commodity products, suffers frequent executive turnover, and competes in a mature market against numerous rivals. The second company, despite current financial similarity, faces far greater probability of deterioration. These qualitative factors, though more subjective than financial ratios, often prove decisive in determining which companies sustain competitive advantages over decades rather than mere quarters. Companies group into sectors based on their primary business activities, and these sectors exhibit distinct characteristics regarding growth rates, profitability, volatility, and sensitivity to economic conditions. Understanding sector dynamics provides context for individual stock performance and portfolio construction. The Global Industry Classification Standard organizes public companies into 11 major sectors, each responding differently to economic forces. Technology companies, encompassing software developers, semiconductor manufacturers, and hardware producers, typically display high growth rates and elevated valuations. These businesses benefit from scalability, low marginal costs, and continuous innovation, though they also face rapid obsolescence and intense competition. Healthcare includes pharmaceutical companies, biotechnology firms, medical device manufacturers, and healthcare services providers. This sector enjoys relatively stable demand since medical needs persist regardless of economic conditions, making it partially defensive. Financial companies, primarily banks, insurance firms, and asset managers, prosper when interest rates rise and credit expands. Their profitability correlates strongly with economic growth and lending activity, making them distinctly cyclical. Consumer discretionary companies sell non-essential goods and services like automobiles, restaurants, and entertainment. These businesses thrive during expansions when consumers feel confident, but suffer during recessions when spending contracts. Consumer staples, in contrast, produce food, beverages, household products, and other necessities. Demand remains steady across economic conditions, providing defensive characteristics. Industrials manufacture machinery, provide transportation services, and supply construction materials. These capital-intensive businesses experience pronounced cycles tied to business investment and infrastructure spending. Energy companies explore, produce, and refine oil and gas. Their fortunes depend on commodity prices, which fluctuate with global supply and demand dynamics. Utilities provide electricity, natural gas, and water through regulated monopolies. Stable cash flows and steady dividends make them defensive holdings. Materials companies mine, refine, and process basic commodities. Real estate investment trusts own and operate properties. Communication services encompass telecommunications and media companies. Defensive sectors, including utilities, consumer staples, and healthcare, maintain relatively stable earnings through economic cycles. Cyclical sectors like financials, industrials, and consumer discretionary experience pronounced swings correlated with economic expansion and contraction. During early expansion phases, cyclical sectors typically outperform as economic activity accelerates. As expansion matures, investors rotate toward defensive sectors, anticipating eventual downturn. Sector allocation decisions, whether through concentration in favored industries or diversification across all sectors, significantly influence portfolio returns and volatility characteristics. Technical analysis represents a fundamentally different approach to market participation, focusing on price patterns and trading volume rather than business fundamentals. Practitioners of this method believe that historical price movements contain information useful for predicting future price direction. Where fundamental analysts examine balance sheets and competitive advantages, technical analysts study charts and identify patterns. The approach rests on three core assumptions. First, markets reflect all available information in current prices, making separate analysis of news or financial statements redundant. Second, prices move in identifiable trends that persist until clear reversal signals appear. Third, history repeats itself as human psychology remains constant, causing similar price patterns to recur across time and securities. Charts form the primary analytical tool. Line charts plot closing prices over time, providing simple visualization of overall direction. Bar charts display 4 price points per period: open, high, low, and close, revealing intraday volatility and momentum. Candlestick charts present the same information, but use colored bodies to emphasize whether prices closed higher or lower than they opened, making patterns more visually apparent. Timeframes vary widely, depending on trading strategy. Intraday charts, showing 1-minute or 5-minute intervals, serve day traders. Daily charts suit swing traders holding positions for days or weeks. Weekly and monthly charts assist long-term position traders. The same analytical principles apply across time frames, though shorter periods introduce more noise and false signals. Support and resistance levels mark price zones where buying or selling pressure historically concentrated. Support represents a floor where demand emerges to prevent further declines. Resistance marks a ceiling where supply appears to cap advances. These levels, once established through repeated testing, guide entry and exit decisions. Volume, the number of shares traded, provides confirmation or warning signals. Price advances accompanied by high volume suggest genuine buying interest and trend continuation. Advances on declining volume raise questions about sustainability. Breakouts through resistance on high volume carry more significance than low volume breakouts. Trends classify as uptrends, characterized by higher highs and higher lows, downtrends showing lower highs and lower lows, or sideways ranges where prices oscillate between established boundaries. Identifying the prevailing trend allows traders to position themselves with momentum rather than against it. Whether viewed as legitimate analysis or as pattern finding in random data, technical analysis remains widely practiced, particularly among shorter-term traders seeking tactical entry and exit points rather than long-term business ownership. Technical indicators, mathematical calculations derived from price and volume data, provide standardized signals that traders use to identify potential entry and exit points. These tools range from simple moving averages to complex momentum oscillators, each designed to highlight different market characteristics or potential turning points. Moving averages smooth price data by calculating average values over specified periods. A 50-day simple moving average adds the closing prices of the past 50 days and divides by 50, creating a line that rises or falls more gradually than daily prices. Exponential moving averages weight recent prices more heavily than distant ones, making them more responsive to current conditions. Traders watch for crossovers, moments when shorter-term averages cross above or below longer-term averages as potential trend change signals. A 50-day moving average crossing above a 200-day moving average, called a golden cross, suggests bullish momentum. The reverse, a death cross, indicates bearish pressure. Momentum indicators assess the rate of price change rather than price levels themselves. The Relative Strength Index, or RSI, oscillates between 0 and 100, comparing the magnitude of recent gains to recent losses over a specified period, typically 14 days. Readings above 70 suggest overbought conditions where prices might be due for pullback. Readings below 30 indicate oversold conditions where bounces might occur. However, strong trends can remain overbought or oversold for extended periods, making RSI more useful for identifying divergences than absolute levels. The moving average convergence. Divergence, or MACD, calculates the difference between 12-day and 26-day exponential moving averages, then plots a 9-day signal line. When the MACD line crosses above the signal line, bullish momentum builds. Crosses below suggest bearish momentum. Divergences between MACD direction and price direction often precede reversals. Volume indicators incorporate trading volume into analysis. On-balance volume accumulates volume on up days and subtracts volume on down days, creating a cumulative line. Rising OBV confirms price advances as genuine rather than low conviction moves. Divergences between OBV and price warn of potential weakness. Chart patterns identify formations that historically precede particular outcomes. Head and shoulders patterns, showing 3 peaks with the middle peak highest, often precede trend reversals from up to down. Double tops and double bottoms mark areas where prices twice failed to break through key levels before reversing. Triangles form as price ranges contract, with breakouts determining subsequent direction. Flags and pennants represent brief consolidations within strong trends before continuation. Breakouts occur when prices move decisively beyond established support or resistance levels. Increasing volume during breakouts adds conviction to the move. False breakouts, where prices briefly penetrate levels before reversing, plague technical traders and trigger stop losses. These indicators and patterns, while widely followed, function best when combined with broader context including volume confirmation, multiple timeframe analysis, and risk management protocols rather than mechanical application of isolated signals. Market movements reflect not only rational assessment of information, but also the psychological tendencies of millions of participants. Behavioral finance examines how cognitive biases and emotional responses systematically influence investment decisions and market dynamics. The field emerged as economists recognized that traditional rational actor models failed to explain numerous market anomalies and persistent investor behaviors. Cognitive biases affect decision-making in predictable ways. Confirmation bias leads investors to seek information supporting existing beliefs while dismissing contradictory evidence. An investor convinced a stock will rise interprets ambiguous news optimistically and ignores warning signs. Anchoring causes excessive reliance on initial reference points. A stock purchased at $100 might seem cheap at $80 despite deteriorating fundamentals, simply because the original price anchors perception. Recency bias overweights recent events at the expense of longer-term patterns. After several years of market gains, investors extrapolate continued rises and minimize crash possibilities. Following crashes, they assume continued declines despite potential recoveries. Loss aversion, perhaps the most powerful bias, makes losses hurt approximately twice as much as equivalent gains feel good. This asymmetry causes investors to take excessive risks to avoid realizing losses while selling winners prematurely to lock in gains. The disposition effect manifests this imbalance. Investors hold losing positions too long, hoping for recovery to avoid admitting mistakes, while selling winning positions too quickly to secure profits. This behavior, selling winners and holding losers, guarantees suboptimal outcomes as portfolios concentrate in poor performers. Overconfidence afflicts many market participants, particularly after successful periods. Investors attribute gains to skill rather than luck, leading to excessive trading, concentrated positions, and inadequate risk management. Studies consistently show that frequent traders underperform buy and hold investors, primarily due to transaction costs and poor timing decisions driven by overconfidence. Herd behavior emerges as investors observe and mimic others rather than conducting independent analysis. As prices rise, more investors notice and purchase, driving further increases that attract additional buyers. This feedback loop creates momentum that can persist for months or years. Fear of missing out, or FOMO, intensifies during bull markets as watching others profit becomes psychologically painful. The cycle reverses during panics. Falling prices trigger sales that cause further declines, attracting more sellers in a cascade. The March 2020 pandemic crash saw the S&P 500 plunge 34% in 23 trading days as panic overwhelmed analysis. Similar episodes occurred in October 1987 during the 2008 financial crisis and numerous other occasions throughout market history. Contrarian investors attempt to profit from these psychological extremes by buying during panic and selling during euphoria. This approach proves psychologically difficult as it requires acting opposite to prevailing sentiment and enduring periods of appearing wrong. Understanding these psychological patterns helps investors recognize emotional responses in themselves and others, though translating awareness into disciplined action remains persistently challenging, even for professionals conscious of these biases. Markets move through alternating periods of rising prices and declining prices, patterns described as bull and bear markets. These cycles, while varying in duration and magnitude, follow recognizable progressions that reflect changing economic conditions and investor sentiment. The terms themselves derive from the animal's attack styles. Bulls thrust horns upward, while bears swipe paws downward. Bull markets, formerly defined as sustained price increases of 20% or more from recent lows, typically last 3 to 5 years and generate average annual returns around 15%. The longest bull market in history ran from March 2009 to February 2020, spanning 11 years and producing gains exceeding 400% in the S&P 500. Bull markets progress through identifiable phases. Early stages feature skepticism as prices recover from previous lows, while many investors remain cautious. Middle stages bring wider participation as evidence accumulates that recovery is genuine. Late stages exhibit euphoria as valuation concerns yield to fear of missing further gains. Bear markets, sustained declines of 20% or more from peaks, arrive less frequently but compress losses into shorter periods. Bear markets typically last 6 to 18 months, though severity varies considerably. The 2007 to 2009 financial crisis bear market erased 57% of value over 17 months. The 2020 pandemic bear market dropped 34% in just 23 trading days before reversing. The 2022 bear market declined roughly 25% over 10 months amid rising interest rates and inflation concerns. Corrections, declines between 10 and 20%, occur more frequently than bear markets and often resolve without crossing the 20% threshold into official bear territory. Markets experience corrections approximately once every 2 years on average, serving as periodic resets of excessive valuations or sentiment. Secular trends operate on longer time frames than cyclical bull and bear markets. Secular bull markets, multi-decade periods of generally rising prices punctuated by cyclical bears, characterize the periods from 1949 to 1968 and 1982 to 2000. Secular bear markets, decades where prices trend sideways or down despite cyclical rallies, define 1968 to 1982 and potentially 2000 to 2013. Sector rotation occurs as cycles progress. Early in bull markets, cyclical sectors like technology and financials outperform as economic growth accelerates. Mid-cycle, industrials and materials gain as capacity utilization increases. Late-cycle, defensive sectors like utilities and consumer staples attract capital as investors anticipate slowdown. During bear markets, cash, bonds, and defensive equities preserve capital better than cyclical stocks. Economic indicators provide context for cycle positioning, though they rarely offer precise timing signals. Unemployment rates, manufacturing activity, consumer confidence, and yield curve slopes all correlate with market cycles, yet markets often turn before economic data confirms inflection points. These cyclical patterns, though irregular in timing and severity, represent the market's continuous process of pricing assets relative to evolving economic realities and collective expectations about the future. Risk management, the process of identifying and controlling potential losses, distinguishes successful long-term investors from those who eventually deplete capital. While eliminating risk entirely would eliminate returns, managing risk appropriately allows investors to survive inevitable downturns and capitalize on eventual recoveries. The goal is not avoiding all losses, but ensuring that individual losses never threaten overall portfolio survival or long-term objectives. Investment risk manifests in several forms. Market risk, also called systematic risk, affects all securities simultaneously as broad market conditions change. Recessions, interest rate shifts, and geopolitical events create market risk that diversification cannot eliminate. Company-specific risk, or unsystematic risk, affects individual securities due to factors like management changes, product failures, or competitive threats. Diversification reduces company-specific risk by spreading capital across multiple holdings. Liquidity risk arises when securities cannot be sold quickly without significant price concessions. Small-cap stocks and thinly traded issues pose greater liquidity risk than large-cap blue chips. Inflation risk erodes purchasing power over time, particularly problematic for fixed-income investments. Currency risk affects international investments as exchange rate fluctuations impact returns when converting back to domestic currency. Volatility, measured by standard deviation of returns, quantifies risk in statistical terms. Stocks historically exhibit annual volatility around 15 to 20%, meaning returns typically fall within 15 to 20 percentage points of the average in roughly two-thirds of years. Bonds show lower volatility, often 3 to 7% annually. Beta measures a security's volatility relative to the overall market. A beta of 1.0 indicates market-level volatility. Betas above 1.0 suggest higher volatility, while betas below 1.0 indicate lower volatility. Technology stocks often carry betas of 1.3 or higher, while utilities average 0.6 to 0.8. Position sizing determines how much capital to allocate to individual holdings. Concentrated portfolios of 10 to 15 stocks allow thorough research and potentially superior returns, but expose investors to significant company-specific risk. Diversified portfolios of 25 to 40 stocks reduce individual position impact, but require less intensive research per holding. Position sizing rules vary by strategy. Growth investors comfortable with volatility might allocate 5 to 10% per position. Conservative investors might limit positions to 2 to 4%. Positions exceeding 10% of portfolio value concentrate risk excessively, regardless of conviction level. Stop-loss orders automatically sell positions when prices fall to predetermined levels, limiting maximum loss per position. An investor purchasing stock at $50 might place a stop-loss at $45, capping potential loss at 10%. However, stop-losses introduce complications. They guarantee sale at the trigger price, or worse, not exactly at the specified level. Gap openings can trigger stops at prices far below intended levels. Temporary volatility might trigger stops unnecessarily, locking in losses before recovery. Risk-reward ratios evaluate whether potential gains justify potential losses. Professional traders often require 3-to-1 or 2-to-1 ratios, risking $1 to potentially gain $3 or $2. This discipline ensures that even with 50% accuracy, profitable trades offset losing trades. Effective risk management involves not eliminating uncertainty, but rather sizing exposures appropriately, so that individual losses, though inevitable, never threaten overall portfolio survival or long-term objectives. Portfolio construction represents the process of combining individual securities into integrated collections designed to achieve specific objectives while managing overall risk. Modern portfolio theory demonstrates that diversification across imperfectly correlated assets can reduce portfolio volatility without necessarily reducing returns. The framework, developed by Harry Markowitz in the 1950s, revolutionized investment thinking by treating portfolios as unified entities rather than collections of independent bets. Asset allocation, the division of capital among stocks, bonds, and cash, exerts more influence on portfolio performance than individual security selection. Studies suggest that roughly 90% of return variability stems from asset allocation decisions rather than which specific stocks or bonds an investor chooses. Aggressive allocations like 80% stocks and 20% bonds target growth and accept corresponding volatility. Moderate allocations around 60% stocks and 40% bonds balance growth and stability. Conservative allocations of 40% stocks and 60% bonds prioritize capital preservation and income over aggressive appreciation. Diversification reduces risk by spreading capital across securities that don't move in lockstep. Correlation coefficients, ranging from plus 1.0 for perfectly synchronized movement to 1.0 for perfectly opposite movement, quantify these relationships. Stocks within the same sector often correlate at 0.6 to 0.8, moving largely together. Stocks and bonds historically show correlations near zero or slightly negative, meaning they often move independently or oppositely. This imperfect correlation allows portfolios containing both asset classes to exhibit lower volatility than either alone. Consider two hypothetical portfolios. Portfolio A holds only stocks with 15% expected annual volatility. Portfolio B combines 60% stocks and 40% bonds, with bonds carrying 5% volatility and showing 0.2 correlation to stocks. Portfolio B's volatility drops to roughly 10% despite only 40% allocation to the lower volatility asset, demonstrating diversification benefits beyond simple averaging. Age-based allocation rules provide rough guidelines. The traditional formula, 100 minus age equals stock percentage, suggests a 30-year-old should hold 70% stocks. Increasing lifespans have prompted revisions to 110 or even 120 minus age. Target date funds automate this approach, gradually shifting from stock-heavy allocations toward bond-heavy allocations as retirement approaches. Beyond asset class diversification, investors diversify across sectors, company sizes, geographies, and investment styles. Geographic diversification reduces country-specific risks, though currency fluctuations introduce complications. Value and growth-style diversification ensures participation, regardless of which approach dominates particular periods. Rebalancing restores target allocations after market movements cause drift. If a 60-40 stock-bond allocation shifts to 70-30 after stock gains, rebalancing sells stocks and buys bonds to return to 60-40. This discipline enforces buying low and selling high, the opposite of natural tendencies. Calendar-based rebalancing occurs at fixed intervals like annually or quarterly. Threshold-based rebalancing triggers when allocations drift beyond specified bands, perhaps 5 percentage points from targets. Tax considerations complicate rebalancing in taxable accounts, where sales trigger capital gains taxes. Tax-advantaged retirement accounts allow rebalancing without immediate tax consequences. Growth portfolios emphasize capital appreciation through stock-heavy allocations and growth-oriented selections. Income portfolios prioritize dividend stocks, bonds, and REITs for current cash flow. Balanced portfolios blend both objectives through diversified holdings across multiple asset types. Through thoughtful portfolio construction, investors transform collections of individual securities into integrated portfolios, exhibiting risk-return characteristics distinct from, and often superior to, any single holding. The whole, properly constructed, exceeds the sum of its parts. Stock markets, though initially appearing as mere venues for buying and selling securities, reveal themselves upon examination to be complex adaptive systems shaped by regulation, psychology, mathematics, and human behavior. What begins as questions about individual stocks and basic transactions expands into considerations of valuation methodologies, portfolio theory, behavioral biases, and market cycles. The mechanics of order execution and exchange operations form the infrastructure, but the interplay of millions of participants pursuing diverse objectives across different time frames generates the continuous price discovery that characterizes functioning markets. The dual approaches of fundamental and technical analysis reflect different philosophies about market behavior and information processing. Fundamental analysts believe that intrinsic business value eventually attracts market prices, making financial statement analysis and competitive assessment the path to superior returns. Technical analysts contend that price patterns contain all necessary information, making historical charts and volume data sufficient for decision-making. Both approaches have produced successful practitioners and spectacular failures, suggesting that neither holds monopoly on market truth. Behavioral finance bridges these perspectives by acknowledging that prices reflect both information and emotion. Cognitive biases, herd behavior, and psychological tendencies create recurring patterns of overreaction and underreaction that generate opportunities for disciplined investors while creating pitfalls for impulsive ones. The cycles of fear and greed playing out across bull and bear markets demonstrate how collective psychology amplifies fundamental developments into dramatic price swings. Risk management and portfolio construction represent the practical application of these insights. No amount of analysis guarantees profits or prevents losses, but thoughtful diversification, appropriate position sizing, and disciplined rebalancing improve odds of achieving long-term objectives. The tension between concentration and diversification, between active management and passive indexing, between growth and value orientations reflects fundamental questions about skill, luck, and market efficiency that remain unresolved after decades of academic research and practical experience. The regulatory framework attempts to ensure fairness and transparency while allowing market forces to allocate capital efficiently. Disclosure requirements, insider trading prohibitions, and circuit breakers represents society's efforts to balance investor protection with market functionality. These rules evolve continually as new instruments, technologies, and strategies emerge. And so, while stock market participation may begin with opening a brokerage account and purchasing shares, it ultimately connects to questions about risk tolerance, time horizon, behavioral discipline, and the role of financial markets in broader economic systems. The study of markets reveals patterns of human decision-making under uncertainty, the challenges of valuing future cash flows, and the persistent tension between individual rationality and collective behavior.